Hi, welcome to another episode of Valuing Stocks. Now, I know it's been a while since I posted a video, and I'd like to do it more regularly. So let's hope that this is the start of a new trend. Being here in quarantine has made me think that, hey, I should start doing these videos again because I am active in the market, looking at a lot of bargains now that the market's come down a lot. And a lot of my friends have been asking me about potential stock picks, stock ideas. And so I thought I'd go through and full disclosure, what I'm going to talk about today is part of my portfolio. And I am invested in this and have invested in what is on the screen. It's a company called Upwork. So the ticker symbol is UPWK. Upwork is focusing on the enterprise market more so bigger businesses, which I think is smart because I think especially with COVID-19 and the pandemic going on, I think the trend is definitely towards more contracting out work and more remote work, and that means more use of freelancers, right? So these are independent contractors that can work on a project for a company. And also, it's less risky for the company because it's not taking on that commitment of a full-time employee. So I think that this pandemic and the economic consequences are going to make managers rethink how they use human capital, how they use human resources, and a lot of companies are going to move more towards contracting out work. So this is just their website, but they've also got mobile apps as well that you can use. One thing I wanted to show you from is the annual report here for 2019. Just to prove my point, this is a letter to the stockholders from the CEO, Hayden Brown, and she says here, this is the paragraph I want to highlight. The expansive economic and workforce challenges brought on by the COVID-19 pandemic represent a shift to remote work that is as massive as it is unprecedented. It is serving as a catalyst to a sea change that was already underway, but is now unfolding at lightning speed, right? So kind of what I was saying, that there's a sea change that was already underway, more towards freelancing, more towards remote work, and this is just going to be a catalyst to accelerate that sea change. You can read the rest of that on your own time. That's in their 2019 annual report. So what I want to do is I want to first go over the numbers and kind of match those numbers up with the story here, with the thesis here, and let you know what I think Upwork is worth today. And you can make up your own mind as if that is a good investment or not. Okay, so getting into the numbers here really quick. Here's a one-year chart. You can see the trend has definitely been down, and since the kind of pandemic started in February, it's been down more, right? Even getting down into the $5 range. And I bought some more shares just for full disclosure. I bought more shares down here. But initially I had invested somewhere around the $10 range. So I thought it was still a good deal back then, and this company had promise, had potential. So, all right, here's the thing. Enterprise value right here on my screen. This is the cost if you were Warren Buffett, let's say, or Bill Gates, somebody with a lot of money, and you just wanted to drop some cash down on the table and buy this whole company. This is how much you would need to buy the company. That is enterprise value. It's distinguished from market cap. Quick lesson for those of you who don't know, a lot of you probably already know this, but market cap is the value of the equity of the company, right? So I like to think about it like your home. So if you own a home, most likely most of us have a mortgage, right? So there's debt that encumbers the home, but we have some equity in there, most likely, which is the difference between the value of the home and the amount we owe, right? That's our equity. So that's like market cap. Enterprise value is like the value of the home. So it's kind of the combination of your equity with any debt that's owed. The interesting thing here with Upwork is they've got negative debt. And you say, how can they have negative debt? Well, they've got basically zero debt, and they've got 100, what is it? Yeah, I guess they've got a little bit of debt, but they've got 133 million in the bank, a little bit of debt. So total, they've got negative net debt, meaning they have more cash than debt. And therefore, if you were to buy this company, you would acquire that cash in the bank, over 100 million in cash in the bank. You wouldn't have to pay very many debts of the company. And so that's why net you would be spending about 700 million to buy the company. So quick lesson there. So that's what the market is placing, the value the market is placing on this company right now, at least as of Friday, the 17th of April. Okay. One other thing to just note here, this, oh, by the way, this Stock Row site, excellent website, completely free, highly recommend it. There's a lot of good data and info that you can get on this website. So here, this is just showing the insiders, meaning management, recently made some purchases in March, and you can see they're fairly sizable, right? That 1.2 million and 1 million, those two people. Always good to see management believing in their own company and putting their money where their mouth is, right? Okay, so what I also wanted to show you is cash flow. All right, to me, I like to see cash flow. It's more important to me, more honest to me than looking at net income a lot of the time. Okay, and there's a difference there between cash flow and net income. Net income is an accounting accrual profit number. Cash flow is just cash flow. It's just cash coming in or cash going out, right? So you can see some quarters, like in 2019, they had a couple of quarters with actually positive cash flow, which is good. This is a growing company. It's a fairly new company, IPO'd in fall of 2018, so fairly recently. And so you'd expect newer companies to be losing some money as they're investing, trying to grow market share, right? But it's nice to see that they actually aren't burning a ton of cash, right? So for the year, they actually were $1 million of operating cash flow. Now, over here, you can see the operating cash flow as well. And just so you know, these three columns are future 3 years projections, right? So this is 2019 in this column here. So you can see they've had, out of the last 4 years, they've had 3 in positive operating cash flow. But then when you take into account CapEx, we're not going to go over what CapEx is exactly. Many of you know that, what it is. These are capital expenditures. Every company needs to spend money to grow, to maintain their business, right? These are beyond ordinary expenses that are like salaries and stuff, but just infrastructure type things, investing in technology or whatever. So this is CapEx. So they are negative. Free cash flow is the holy grail number. That's what we want to see, is positive free cash flow, because we know the value of any business is the present value of its future free cash flows, right? Which are the cash flows that are available to the common shareholders. So they're getting there. So there's been a couple of years positive. This last year is negative. All right, so now let me go to another website I really like. This is actually a paid service. I can probably put a link down in the description below. All right, so Finbox is a fairly new website. It's been around for a couple of years, and I've been using it for the last couple of years. It's a paid service. They do have like a free trial, or for $1 you can try it out for a few days. So I would look into it if it looks interesting to you. They basically help you model like a DCF, do some different valuation models on a company, and come out with a fair value conclusion. Okay, so this is the model that I've worked on. So you start with a base of numbers that they have, and then you kind of tweak them as you like. So I've tweaked some of their numbers here. So you can see kind of the assumptions I'm making here as far as discount rate, the perpetuity growth rate, right? Growing 2%, kind of the typical growth rate, which I like to keep equal to about the 10-year treasury. That's what Oswath the Motorin would say you should do for your growth rate out into perpetuity. And you can see that the fair value I got was $14.89. The stock's trading in the $7 range, so it's upside of 100%. So you double your money if it goes to fair value, if this fair value is in fact correct. But disclaimer, right? These are my assumptions. I'm not saying it's correct, but this is what I believe. So down here, you kind of map out the revenue path. So you see the projections for future revenue. All of these here up to the end of all of these here. Yep, all of these here. Yeah, all 10 years here. I didn't touch these. Finbox does some, I think they have some connection with analysts and get consensus numbers from analysts. So, their numbers are probably as good as mine would be as far as projecting into the future. I do know at least this next year number, 341 million in revenue, growing 13%, is in line with, I think if you look at their last, right here, so their last quarterly report, they are giving guidance in 2020 of a range of 340, 345, right? So we fall right within management's own guidance. So at least we know 2020 is pretty good, although everything's got shot to heck with COVID. Every company's withdrawing their guidance. So who knows, right? But let's just, and 1 year, if we're wrong on a couple of years in a DCF, if you do the math, it doesn't really matter. If you're not, if you're like way off, maybe it matters. But even if you're pretty far off, if it's just 1 or 2 years, it's not going to matter in the grand scheme of things. Actually, what the thing that really matters in a DCF, just so you know, is the most important thing is this last year assumed cash flow number, because that's going to give you your perpetuity value, and that really is the meat of your DCF valuation. So we're really just trying to figure out what that number is in the future. Okay, so let's go click here, calculation free cash flows. I'm not going to go over every detail Finbox. Maybe we can do another video sometime to show you around, but basically you can see here, based on my assumptions, these are the years, these are the free cash flows down here. So I'm assuming, maybe a couple years in 2021, they finally break positive or even on free cash flow, and then start to go positive from there and just ramp up. And the reason is, a lot of times, for companies, just like just think of your own household budget, right? You got a certain number of fixed expenses. And if you get your income growing, and at some point it grows high enough where the growth of that is exceeding the growth of your fixed expenses, right? And so every incremental dollar that you make in income is just kind of pure discretionary income. For business, it's the same. At some point, they meet all their fixed costs for the business. As they grow, they may have some incremental costs here, but a lot of the revenue at some point starts to just drop to the bottom line. We call that operating leverage. So it's great to have a company with operating leverage. You don't want a company where it's like every dollar in revenue that you gain, you have to spend $1 to get that, right? You want a company where it's like every dollar in revenue you gain, you spent 20 cents to get that, 30 cents to get that, right? And then more of that starts to drop to the bottom line. So that's what you see going on here. And so let me move my video there. So at the end, in the last year in our model, you get to a free cash flow number of $173 million, right? And that's off of a revenue of about 700, almost 800 million. That's 800, over 800 million, sorry. I gotta move this, over 800 million. I'm assuming that these margins, these EBITDA margins, this is EBITDA, earnings before interest, taxes, depreciation, amortization. I'm assuming that those margins increase to about 22%. So a lot of marketplace businesses like eBay, where they're bringing two groups together on the internet, right? It's not a super capital intensive business. So profits are pretty fat. And so those businesses do around 20, 25% EBITDA margins. And so I'm assuming that Upwork is able to scale with network effects and everything, bringing freelancers and employers together. They create that operating leverage and scale and are able to attain those type of margins, right? Which is not, I don't think it's unreasonable. All right, so once we get that $173 million terminal value or terminal cash flow number, you can see here what they're doing is they're taking the cash flows for the 10-year period, adding them together, but taking the present value of them, and there's three different discount rates here. We're going with this middle one of 9% discount rate. And so the present value of those cash flows over the next 10 years is 513 million, right? We said the company, you're paying about 700 million right now. So you're almost getting the value of the company paid back to you over those 10 years, right? And then if we assume growing into perpetuity at 2% at this 173 million a year in free cash flow the company's generating, you discount that back, which 10 years from now, so you got to discount it quite a bit, and then you get about $1 billion, over $1 billion is your present value of the terminal value. And I know a lot of this is sounding like gibberish to you. Probably have to do a more in-depth video on discounted cash flow models and what this means. But you basically add the cash flows you're expecting over the next 10 years with the cash flows after that 10-year period, just into perpetuity. They're saying, okay, the value of all that going from year 10 to infinity and discounted back to present is about $1 billion, right? And so you add those two together, the value of the enterprise, the full company, right? Like the whole house in that example I gave, is $1.6 billion. But to get the value of the share, so that here's that $1.6 billion number. We add the cash back to it, and then we subtract out, I guess they have 43 million in debt. And so total, the value is almost 1.7 billion, right? You got 114 million shares. That implies $14.89 stock price. Okay, so that's how we get there. I always like to think of kind of additional catalysts, right? Maybe the market won't see the value here. Maybe it'll take some time, but maybe there's another company who wants to get into this space that could look at Upwork as an acquisition target. And so I'm thinking, I don't think it's totally unreasonable. It's probably not a high likelihood, but I don't think it's totally unreasonable for a company like Amazon, for example, a big player. Amazon's already got some services like MTurk. I don't know if you've ever seen that. It's kind of like a freelance thing. It's like a mechanical Turk. It's, having people do jobs that AI can't do yet, like gathering data and doing different things like that. I've used it a couple times. But you could see Amazon just like, let's just like dominate the freelance marketplace. they've got like a lot of drivers and other type contract work that they are managing, and there's like, dude, let's just take over the entire freelance world, industry, and just buy this #1 platform, and it's going to be a lucrative business for us. We're going to have the Amazon brand name on it, so a lot of enterprises will trust it and use it for their various project needs, right? And it would cost Amazon today $700 million, right, to do that. Obviously, they're going to have to pay a premium. So let's say they drop $1 billion or $1.2. It's pretty insignificant for them, but you think about the potential upside for them if they truly globally dominate. Let me just show you one other thing. This is from their Q3 report. So they're saying they believe their market, this freelance contractor professional service market, is that it can be performed remotely. It's 560 billion, right? It's a big number, and something that an acquirer like Amazon might be interested in tapping into a $560 billion market, right? Or Salesforce.com. Okay, so components of revenue. Let's see. Let me zoom out. Okay, so this is just showing quarterly, last several quarters. Their revenue is this take rate here. This number up here is the gross service volume. So this is kind of the total value of services that run through their platform each quarter. So you see over the last 4 quarters, it's over 2 billion. If you add those up, and then this is their revenue. It's about 300 million over the last 12 months. And this is the breakdown. So most of the fees are actually paid by the freelancers themselves. I've tested it out just because I was investing in the stock, and yeah, you have to pay to bid on a project. It's just like $1 or $1.50 or whatever for a lot of projects, but you got to pay to bid, which I think actually makes it a better marketplace because people are not bidding on things that they really don't know how to do, right? They're going to be more selective if you have to pay to bid. And then clients pay a portion as well, not as much as the freelancers, which is good because you kind of attract clients saying, hey, you actually don't pay a lot of the fees. And then part of this growing part of their business, well, what they hope to be growing is this top part here. It's managed services. That is where they're trying to say to enterprises, to large businesses, like, hey, HR person, why don't you allow us to help you with some of your projects or some of the work that needs to get done at your company. You tell us what you need to get done. We will find the freelancers for you. We'll help manage that, get the project done for you. And then, of course, we take a fee for that. Can be a win-win situation, can be somewhat cheaper for the company, and Upwork makes money in the process. The freelancer makes money in the process. So anyway, I know we're going super long on this video, but that's the thesis there. That's the numbers and the story. I think you have this catalyst with the pandemic and people working from home at unprecedented levels, and I don't think it's unreasonable to think that a lot of businesses are going to say, why don't we keep this going? It's actually cheaper for us if we do more things remote. If we contract this out, next time we have a big downturn, it's not so hard to lay off people, right? They're just contractors, so we just don't send them any more work. It's more flexible. And so I think that Upwork could actually see an acceleration of revenues. All right, so if you enjoyed this video, please subscribe. I'm trying to build up my subscriber numbers so you can help me get over that 100 subscriber mark. I know we're starting slow, but we'll get there. And if you want to put a like on it or comment if you disagree or agree with anything I said, if there is a stock that you want me to cover and look into a little bit deeper and do a video, please let me know in the comments below. But anyway, enjoy, stay safe, stay healthy. Thanks.